Welcome back, folks. Back in the saddle again. All right, so we're looking at the weekend edition for January 9th, 2021. This lesson, we're going to be talking about factors in avoidance. Obviously, we're going to be looking at the dollar index, euro dollar, and cable. But I want to teach a little bit and talk a little bit about how I determine whether or not there's a market that I generally like to follow, but I'm keeping my hands off. Now, obviously, you've known for a number of weeks and months now, I've been avoiding cable. I'm going to show you some of the things in the chart that led to that determination. Despite it moving sometimes like we were looking for it, that's not enough for me to say, well, I've changed my mind. I'm going to now start trading it. I'm going to show you certain signatures in price that helped me avoid trading that particular pair, and why our focus was primarily on that of euro dollar. All right, so we're looking at the economic calendar for the week to come. On Monday, we have medium impact for Canadian dollar at 9:30 a.m., Bank of Canada Business Outlook Survey, and ECB President speaking for medium impact for euro about 10 minutes after that on Monday. On Tuesday at 5 a.m., GBP has medium impact speaker. And then Wednesday at London Open 4 a.m., euro dollar has a medium impact speaker. And then 8:30 a.m., dollar has CPI. And on Thursday, we have unemployment claims, medium impact for the dollar at 8:30 a.m. And at 12:30 p.m., high impact Fed Chair Powell will speak. And then Friday at 8:30 a.m., high impact dollar, core retail sales. All right, with that, let's get into our lesson and commentary. All right, so we are looking at the monthly chart. So I'm going to try to be referring to this not every single time we do a video, obviously, but when we start a new month, the first lesson in that month or commentary for that month of the year, I will bring in the monthly chart, so that way we'll be able to refer to specific things that this time frame would present us. The weekly chart will always be in the commentaries from now on, and then obviously we will still work within the realm of the daily, the 1 hour and the 15-minute charts respectively. So I also want to remind you that as we go into this new year, I'm going to be giving you the lipstick right away in this video because I want it to be a little bit quicker because I'm doing all this jawboning. But every video after this particular one, I want you to try to have your annotations in your chart before you watch mine, okay? Usually you see me doing very light annotations, and I'm drawing your attention to certain things. And while I do personally believe that that is the best way to do this from an educational standpoint, it does weed out the lazy, but there's also some folks that are coming through and they're in month 3 or 4 or 5 and they start feeling that pressure. They're like, I'm running out of momentum. I'm running out of inspiration. I see the stuff that's being taught and I see the things unfolding in the chart, but I just can't resonate with it yet. So this year, over the holidays, I've made a decision. I was going to provide a little bit more of what it is that I like to see in my annotations. Now, clearly, it's not everything, because in my charts, I'll make reference to certain things that I'm not going to divulge publicly. That means even in here. So, and what do I mean by that? Like orders that I would take for a trade, areas where I would use my stop, and where I would take my initial profits, scaling out, and things like that. Framing my actual trade. So you're not entitled to that, and because I don't run a signal service and I'm not trying to give you trades, that was not what you signed on to. You signed on to learn how to read price action, which will at some point take you to a crossroads, and you'll determine whether or not you want to voyage into live trading at your own discretion, not by anything that I would instigate or prod. In other words, I don't say, okay, now start trading live funds. So without saying anything more and boring you, just know that the annotations in the chart will be a little bit more richer as we go through this year, but we're going to warm up with very light annotations because of the time of the year. As I mentioned on my community tab on the YouTube channel, reminding those that are already here, and also providing as a free service to those that watch and read my community tab, that January generally is a month where everyone on the institutional level, they basically do a lot of planning. They do a lot of analysis and sentiment reading and try to determine what next intermediate term trend may develop, okay, or which intermediate term trend may be ending. Okay, so it's a matter of being flexible. All right, so we'll talk a little bit about that, but mostly what leads to me avoiding a particular pair and what things should be in the chart, or what things that are in the chart that lead to that determination on my part. So hopefully that'll help guide you. And just know that this isn't a lesson where you watch it one time and you're like, oh yeah, I know how to do that now. It's not like the last up close candle is every bearish order block. That's just the same thing. You can't just take one lesson like this and walk away thinking you understand everything. It's one of those things that experience is the best teacher. All right, so monthly chart for the dollar index. Okay, so we've seen how the market came back up and hit here. We already outlined all that. We anticipated that nonetheless, not on the basis of it being this particular level, but I'm bringing in the levels from the higher time frame that led to a lot of the things you heard me say over the past few months. We have a rejection block in here, which is the last down close candle's closing price. Then we have the sell side liquidity pool resting below this old monthly low. We have yet to trade down to the rejection block, so we'll see if it wants to do that at a later time. Right now, it looks like it may want to dig into this sell side imbalance, buy side inefficiency a little bit. Does it need to come all the way back up to this candle's low or even revisit this bearish order block? I personally don't think so. I don't think that's the case. We had a lot of events happen last week in the US, and that has sent some concerns throughout the markets, and sentiment is not clear. Okay, so what will happen is the central banks will start shaping that sentiment with price action. So while I'm still bearish and I'm looking for a run below this eventually, and then targeting this volume imbalance right here, you see that? So I'm looking for this over the course of the first 6 months. Now, that's a lot of time, Michael. You're saying it may take 6 months to get down there. We may have to go into a period of consolidation for a month or two because of everything that's been going on, U.S. elections, and the invasion of the Capitol building, all that business. So there's a lot of things and a lot of narratives that are presently on the table, and I'm not sure which one they're going to run with. And to be honest with you, I'm not sure they are really decided on what they want to work with, but they generally in January present some measure of consolidation. And more, well, if you look at this period in here, okay, beginning of 2017, we consolidated there a little bit. Wasn't a lot of price action movement. It just stayed in a range. Same thing in here. We worked inside of a range a little bit for a month or two, and then it finally left. So it doesn't take long to look at, the ideas of the beginning of the year not being in a rush. And we had this over here with 2020, okay, which was a little bit wild, but nonetheless, it's a time of the year where you have to relax and try not to rush, unlike retail traders that are just, okay, we got through the holidays, it's time to start trading again. The markets are open, that means I got to be trading. No, okay, you're not trading just for the sake of trading. You want to be in high probability setups. And for those that are watching this that are in the new group, they're not able to watch this video until they start coming in on the 27th of January, but I'm sure you'll be watching this video eventually. And I want to remind you all that this is something that we teach here as a general rule of thumb. January, and this is the reason why I sit on my hands and don't really trade until the first trading day of February. I use the month of January as a intel collection period where I'm just trying to get a lay of the land. I'm trying to figure out what they're most likely going to try to reach for on these higher time frame charts, and I work with that as a context for the next 6 months. Now, it doesn't mean I'm going to hold a trade that long. It just means that I'm looking for scenarios that would lead to that general direction. And as we get closer to that, or if we see something entirely different, then I can change my mind or change my analysis or just move to the sidelines altogether. Like you've seen, for those that have been in the mentorship for several years now, you know that there's periods where I get cross signals. So therefore I'm uncertain. So I say, okay, I'm waiting for more information and we have to wait. And you see why we have to wait. There's a general consolidation or a pause, or the market does something squirrely and it doesn't make any sense. And then it does something else that we anticipate, and then we get back in the rhythm of what the market's likely to do next. That's normal, okay? But we don't freak out, we don't lose hope, and we don't abandon the ideas because the market's not lining up something right now for us. It doesn't mean that the algorithm's broke or it's been changed. It just means that the markets are in transition. And what does that mean? We're transitioning from a trending environment, which is what we've had over the last couple months. Now we're at the beginning of the year when it typically will be range bound. Okay, so try not to be terribly excited about any short-term price moves, and just have it in your mind that this is a normal instance where price doesn't generally create these sustained price runs right around this time. Now we're in unprecedented times, so that might be a little bit different, and it might upset the normal tendency for January, or the January effect as I teach it. So I give you a lot of preamble there, so we'll be able to go through the rest of the video pretty smoothly now. But I believe that this will eventually be a mark for the first half of the year. How much time we need to spend in here is unknown to me, and I'm willing to submit that entire month of January and not worry about it, and let it give me more insights as we go into February. So when we met last time, I mentioned how we could potentially trade up a little bit into a buy-side liquidity pool in dollar, and we'll look at that when we get into those other charts. Let's move into the weekly chart. All right, so we have a fair value gap right in here in the form of a sell-side imbalance, buy-side inefficiency. So one single pass here with this candle. Do we need to come back up into that? That's what I'm trying to determine, because we did dig into this consolidation with this drop here, and we've had multiple times going lower, and it's very difficult personally for me to get a read on what they may work off of, because just because we have went into this range, and we can look at the equilibrium of this price range low and price range high, split that in the middle and see we pretty much worked at that level. I am not trying to pick a low or a bottom in dollar. Now, when I am bearish on a market, I'm not likely to always be counter trend trading, even if the signal looks strong. Sometimes I'll just wait and let it pan out. For instance, it might trade up to that fair value gap. It might trade up to it and then create another opportunity going lower. Or it might trade up to that fair value gap, start to drop down and fail to go below this low, and then make another more significant price run higher. And then we'll have to wait at a longer time into the year, if at all, making a run below here. So that's the equation you work with. Now, if you listen to the language I'm using here, this is not how I usually talk. Usually I'll say, this is what I'm believe is going to happen. I'm siding on this side of the marketplace. So therefore, if it goes up here, I'm wrong. It's not a setup I would take, but I'm sticking to this narrative and it's likely to go there. Notice that that's not in this discussion. This is always how I view the market in January. So I am letting the market show me what it wants to do. And I'm not trying to take a trade. And if you are one of those individuals that are foolishly trying to trade with live funds while going through the mentorship, Do not try to trade in January. I don't care who says they made this or how many times you've seen your chart setups pan out. It's just not a good period to do it. Okay, just give up those couple weeks of the year. And I promise if you do that as a routine, you won't be in a rush to trade. You'll have a better view and a grasp on what is likely to occur February into March and April. That to me is a fair trade-off. Having more intel, more insight, more clarity, visibility, if you will, of what price may do. Whereas right now, really nobody knows. Okay, it could do anything where it's at right now. It could turn on a dime here and go right up into that fair value gap and even go higher. I don't know that. I don't know if it's going to consolidate here. I don't know if it's going to go down below this low. I would venture to say that it's going to retrace a little bit more if it's going to go lower. And we can watch the opening on Sunday. If it gaps up, fills it, and starts to rally back above the gap, that would be an indication that's near-term bullish. And then we could take our attention to this fair value gap. But the idea of having a very strong conviction that it's absolutely going to keep going lower, while that is my underlying bias, I'm electing to anticipate short-term retracements that could reach up into this fair value gap. It doesn't necessarily need to fill it entirely, but I do think it will be some measure of a draw on liquidity, at least from a weekly standpoint. All right, so the daily chart on the dollar. All right, so I have a couple things on here, and right away you can probably determine why I avoid doing this much annotations on my commentaries, because when we were having multiple groups coming in throughout the year, they would be starting with month 1, month 2, and they see things like this. Like if I don't say anything at all, imagine you don't know what you know, and I show you this chart right here. You're like, what is that? What are those levels? Why are those lines there? And why didn't he highlight this or that? You see what I'm saying? So that's why having annotations on your chart is a personal thing. But I'm going to guide you all this year with majority of what appears in my own personal charts. Okay, so while I don't dress TradingView charts for myself to trade off of, I use a separate platform. Now, right away, your mind's thinking, oh, well, that's the advantage. So tell me what that platform is. TradingView is perfect for you. You're developing, okay? You're not supposed to be trading with live funds. So what platform I'm using is of no concern to you. In charter level, once you get there, once we get everybody in the charter level now, because this is our final group, I'll start showing you my live platforms, and you can see my charts and things like, not on a daily basis, not on a routine basis, but you'll see that the way I do it in a quote unquote institutional platform, it's basically what you see me doing here in the education. So that way there's no confusion. There's no advantage over this or that. The charts are the charts, period. It doesn't make it, there's no advantage, okay? As long as the data is solid, then you don't have anything to worry about. But with looking at this chart here, I want to go over a couple things, and what I'm showing you is, now in my mind, this is how I see it, but in my charts, this part is not in the chart, okay? And what do I mean by that? I'm not highlighting this high, which I'm doing here, to note that range high. I'm not noting this low for the basis of having this range high and this range low, marked out. Why am I using this high to this low? Well, we have the market come down in here, trade up, and then we broke down through it. So I want to consider the potential of maybe needing to come up into this swing high without breaking it in a retracement. Now, I'm not saying it's going to go that far, but in terms of determining range, to work within a range like this high and this low, it doesn't need to go above this high for me to find opportunities. And if it does retrace higher, what levels could it potentially trade to? And if this is a breaker, which by all indications it looks like it is, and we broke through it here, I only want to use the nearest swing high in the context of this swing down. So every down close candle consecutively, that's your bearish breaker. So essentially this candle's low, extend it out in time. I want to go into the breaker, not just the butt end of the tail or the candle's close. I want to consider the entire range of that breaker, and that swing high is inside of this breaker. You see that? So I could have had a whole lot more annotations here, so you got to take notes with what I'm saying, and in your own charts kind of replicate what you see here and then fill in the gaps with what I'm saying verbally. Okay, so the audio commentary, those things you want to add to your chart. I just didn't want to have too many things on here, and the things that would otherwise be in my chart I'm giving you audibly. Okay, so but I want you to know that I'm not looking at the chart with this level here and this level here. In my mind's eye, okay, and as I look at price, I'm looking at this range and I'm splitting it in half. That's this level here. This is equilibrium. So everything below that level is a discount. Everything above that level is a premium. So if it's going to retrace to a premium at this level, what resides above that? Well, we have this short-term area here where there's relative equal highs. So we have buy-side liquidity there. We also have a volume imbalance there. Plus, we have a weekly fair value gap that it could trade right up into that for an institutional order flow entry drill. It doesn't need to completely close that in, but it could need to retrace back up into this level and this level. This level here, the dotted line, that's the 62% retracement level, and this is the 79% retracement level, respectively. From the high to the low, if you drop a fib on your chart, you'll see that that's what these are, which is optimal trade entry. So does it need to trade back up into institutional order flow? It might, but I don't know. But it will have to determine that if we trade to a premium, which is at or above this level. But if it gets to this level, we could anticipate a run into this level here, which would also be almost consequent encroachment of the weekly fair value gap. Now notice I've transposed the levels from the weekly and the monthly into this chart. So when we drop down from the monthly, the weekly to now the daily, everything has a better context. And this is the reason why I said the lazy don't survive here. But I guess I shouldn't say some, there's a lot of you in this most recent group that joined in 2020. They need a little bit more hand-holding. And because we have an enormous group coming in that starts on the 27th of January, I kind of like want to give as much as I possibly can in terms of hand-holding, so that way it teaches you by repetition what you should be having in your chart, what your chart should look like. But I'm not going to just show it to you like this when we do our commentaries. What's going to happen is I'm going to have the charts blank initially, and it'll be a way for you to say, okay, this is how he has his chart right now. And then what you can do is set your chart up with the same amount of data that's showing, okay, and then try to put the lipstick on your chart and pull out the things that you think are salient. Okay, in other words, what is most likely the most important things right now, given the current market structure, the dealing ranges that are available, and what PD arrays are likely to be traded into. And that way, you will have a day-by-day opportunity to test yourself. Okay, so it's not something for you to see you fail at and say, oh, I'm never getting this. Okay, I want you to understand that it's going to take time for you to start matching up. And most of you probably will never have it exactly like my charts until you become a charter for a while. But while you're in the core content, and here's the thing, the charter members never really had this. So they can go through month one, right now in January, and revisit all this stuff again and relive now with a little bit better, application of what it is, because they know what PD arrays are. They know most of the things that you are learning while in core content. So they have a lot better advantage because they've been here for a while and they've gone through some things. But you as a developing student that are new coming in here, then from the new group for 2021, you want to be doing what I'm showing you here in your own charts before you look at mine. If you don't do that, I promise you, if you don't find a period of feeling like you're not learning anything or you're not seeing something, okay, you will around the second or third month. If you're not somebody that goes into the charts and back tests and look at price action and study how the things I'm teaching appear in that, you won't feel like you're developing. So what I'm doing is I'm taking you by your hand and I'm giving you the opportunity to say, okay, this is what your chart should look like at the moment. And then you go into your own charts, pause the video, go into your own charts and replicate what you think is going to appear in mine. Now, what I don't want to have happen is for you to feel like, all right, I'm going to put this on my chart and I'm going to send it to you, or me rather, in email. And this is what I had in my chart, because if I had all of you doing that, my email box will have 40,000 emails in it and I'll never get through it. And it'll be a nightmare. I want you to think about the application of me sharing with you my charts. Okay, I'm going to be providing that to you as a way of helping you understand it. Okay, so when we do our weekly reviews, it'll be the midweek review and on the weekend. At some point, I may start doing it as a upload to the forum. I just don't know how I'm going to do that because I still have to worry about having watermarks and everything. So I don't know how I'm going to do that part. So in the videos, everything's grouped by user groups and usernames that you're not aware of, that we're giving everyone. That's not necessarily the username that you're given to get into the forum. So the watermark that's on your videos, that goes to a specific group of members that's in a member group. So if my videos start getting circulated, then I can see right away, oh, this is that group of 25. So now I got to just whittle down 25 people that's doing it. And it doesn't take long to do that. But it's important for you to put your effort into trying to determine, based on what you know at the level of your mentorship. So in the beginning, it's unreasonable for you to have any idea what your chart should look like. But by seeing a naked chart, which again, as a reminder, I did not do that with this lesson here. Just imagine all the lines and annotations that's on this chart here not being there, but just the price chart itself. That's how the commentaries will go forward. And then I'll say, okay, if you don't want to see the annotations, you need to pause the video now or stop it, because I'm going to add it and then it'll be there. Okay, so it'll help keep my focus on the discussion. And that's why I said this video is going to be a little bit longer than the ones going forward, because I really want to frame out your expectations on how I want you to see why we're doing what we're doing. Okay, so it's going to be more structured, it'll be more interactive, and it'll provide you a way to kind of like come up to speed a little bit quicker. But for some of you, you didn't need this, and I commend you for that. But I don't want anyone that feels like that this was the thing they needed to feel like they were less intelligent because they needed it. Because I used this as a way of weeding out the lazy. Because I've had people in previous groups come in and like every day I got 20 emails from them for questions that would otherwise be answered if they just did the things that I'm showing you here. Okay. In other words, they just want to have me give them everything, a spoon-fed response to everything. I'm looking at this chart right now, and really what they're trying to do is warm me up to telling them their trade idea is good, go ahead and take it, which I don't do that. Okay, so anyway, take this level off your chart, take this level off your chart, take this level off your chart, and these levels here off your chart, and this annotation of OTE, and that's leaving just this level and this level, and that's all that would be on my chart personally. But from a perception stance or a point of view, this is how I am internally seeing it. Okay, how I look at this run in price, why I'm using this high again, and I'm not sure if I did a good enough job, so I'll do it again here. Why am I picking this high? Because inside of this candle's high to this candle's low, because they're consecutive down close candles, inside this turning point that comes up to this high. So we had this high and this high. This is a breaker once this low is broken here. So when we had this price run all the way down here, if this is going to retrace, I want to look at and refer to the swing high that's inside, if there is any, because there may not have been a swing high in here. If this swing high didn't exist, or this one in here, then I would just use the butt end of the breaker, of its tail. Okay, in other words, this candle's low. I would use that as the range high, because that would be a PD array or a specific level that the algorithm would utilize. But because there's a swing in here, it may need to go into that last up close candle, and if it breaks this, then obviously it changes everything. But I'm willing to see it trade up into this candle because it's a swing high, but not break it. So with that, in terms of understanding the range, I'm using this swing high within the total range of what would be deemed a bearish ICT breaker. And what a breaker is we have a high, a low, price runs up, upsetting anyone that trailed their stop loss in here, and then it goes lower. Once it breaks that, then we have market structure, momentum, everything going lower, institutional order flow bearish. But if we're looking at a level now where, all the things that's been going on, the uncertainty in the US, and we're at the beginning of the year, if we need to retrace higher, this is the framework I'm looking at. Okay, I'm not looking at up here like this is a low resistance liquidity run. If we were bullish, like I would look for these levels here to frame out a low resistance liquidity run to that level. Now, if we run above and find some support inside this area here after going higher and starts to rally, then I would concern myself with that potential scenario and put this whole business down here at a later time in the year, or maybe even abandon it the entire year based on what we see and what comes out of DC and all the things that's going on. So I think I've done enough discussion on this daily chart, but nonetheless, you really want to take advantage of testing yourself, and don't look at I got this wrong. Try to focus on the things that you do get right in your chart annotations before you see mine going forward. Okay, not this video, but every video after this particular video that we're showing you now. All right, so this is a 60-minute chart on the dollar index, and you can see obviously there's a whole lot more business here. We have a buy side liquidity pool here. We have a real gap. Okay, this is an actual gap in price, and just like we have an actual gap here, fair value gaps are annotated. Obviously, you can see it in here, and price moving up into them respectively, and then we have the market come down here, break a short-term high. As we got close to those levels that I shown on the monthly and weekly chart, we went into the consolidation that was really the old area of order flow. Remember what I said back on the monthly chart and weekly chart. So we went into more or less the equilibrium of that old range, but we have not broken it. We have not traded down to the rejection block or below the old low on that monthly chart. So we're digging into that consolidation, and then you always have to anticipate the likelihood of a potential reversal. That's why we teach taking partials and trying not to jam your stop loss too aggressively or trail it too aggressively, because these scenarios here may present themselves. And if we have the area traded down into, as we talked about on the midweek review, we could potentially see dollar trading higher and go up into those relative equal highs and into that buy side liquidity pool. That sets the tone for what? Very, very short-term bullishness. But at the time, my bearishness was still in operation. I was still looking for, and I still might be there, okay? It might need to go up to this level here, clear this buy side liquidity, and then something's released in the marketplace. Maybe Powell says something on Thursday that sets everything in motion, and then they start to drop dollar aggressively, and then euro and cable's allowed to trade higher. We don't know that yet, okay? And because it's the month of January, I'm again reminding you that this is a month where I'm not trying to just take a trade because it's possible. I'm trying to get a read on what the market's going to be doing for weeks and months, and then I'm going to operate in that context where it gives me a whole lot more probability trading with that mindset. Okay, so in other words, the momentum or direction the market moves in for weeks or months, okay, that is much more sustainable in terms of being right in your directional bias each day. Doesn't mean your directional bias or my directional bias will be right every single day. But if you're trading in that same direction, you're trading with the highest time frame institutional order flow. So it's more advantageous for you to have that. And if you try not to do that, you'll be very frustrated, and basically it's probably what's going on right now for some of you. You're looking at these daily charts to intraday, and you're not seeing the big picture that helps frame the commentaries that I do. And I'm giving you, like, I'm pulling back the veil and I'm showing you the things that I use to keep that daily chart in the right perspective. Doesn't mean I'm always right. This means that these are the things and the applications I use to help me do that. All right. And if you start doing it, you will see that there's a stark contrast to not doing it, and when you do use it, it's very helpful. So we have a market structure shift here when we have this short-term high broken on the upside, and it comes back down in. We have an imbalance here, and then we have the order block, which is the last down close candle. We always want to use the candle that has the biggest beefy body candle or the lowest close, okay, in that order of selection. So I'm looking for the biggest down close candle, because there may be like this one here. Even though this has, again, this could have went a little bit lower, but because it's broken over 2 candles, I would have elected to use this one, okay? So there's an hierarchy there. That's algorithmic, okay? That is not a rule that has been shown or taught and broken down with the specifics. And this is the reason why I get upset when I see people that just watch my videos and they think they're going to go out there and start getting ad revenue on YouTube, making videos about order blocks, and they have no idea what they're talking about. There's a specific order and hierarchy of what you're supposed to be looking for. That's how I can find the right ones and do it with live trades and show you examples of me doing it versus everybody else talking about on the left hand side of the chart. So we have an order block here, the high and the low. That's the entire range. You can see we traded back down to mean threshold of that. Moving it back above this high here, because we have a higher low than this one here. Now think about like the breaker. The mitigation is the failure to make that lower low on this run. So in other words, if this one went lower and then price did this, this would make this a breaker. But because we have this low high that breaks the short-term high here, when it comes back down, if it runs back above this high here, this is simply a mitigation block. And for those that are brand new coming in, that is taught specifically. You have rules about that too, and it's all taught in future lessons. But right now, what I'm giving you here, if you have questions as you're watching these videos, you want to write down the date and the things that came to mind as far as a question about whatever I'm talking about. And in this video, we're talking about a lot. So right away, you're going to say, what's the difference between a breaker and a mitigation block, and what's the advantage of knowing that difference? Well, when we have a potential contrarian price move, okay, in other words, we've been bearish on dollar and we are anticipating lower prices on dollar. But if we have something like this occur where the structure is now seeing a shift after it's traded down into a level where it potentially could turn, we don't know. We're likely to side on it going lower, but if it does give us indications that it want to go higher, that is something that we have to be concerning ourselves with, which is why I mentioned on the midweek review that we could potentially trade higher in the dollar index and need to retrace deeper. If it doesn't make a lower low here and then trades back above it, this is going to be mitigation. That means that they're going to be wanting to use this level here as you would expect a classic support resistance idea, but not just to the high. In other words, because if it was that easy, it would be just this high here, draw that out in time. Well, it went below it here, and it went below it here, but then still went higher. And these are the things that I encountered as a new trader in the 90s, where I felt that support and resistance was a trick. Like it didn't work. I couldn't make it work. Just like trend lines. Everybody can find the perfect trend line after the fact. But the key is knowing what you're looking for when the chart's alive and breathing and creating the candles. That's the difficult part. So what my endeavor has been through my whole career was to decipher why it needs to come back to this range here. Okay, what range is that? The high of this candle and to the high it creates here. So when it comes back lower, once it breaks above this high, I'm concerning myself with this old turning point. I'm also referring to this candle's high here and this candle's low here. That's your fair value gap. So if it does need to trade back down in, we have institutional order flow entry drill that could happen here, or the mean threshold, which is the midpoint of any gap, and extend that out in time. You have it here. What's interesting is if you take this swing low here, and it's a low that has a higher low to the left and a higher low to the right, you can also have this on your charts too. In this low up to this high, why this high? This is the highest high prior to this dip down that went back into the fair value gap. This is an optimal trade entry. And just running back from here to here, that's a trade. That's a scalp. That's a bread and butter setup. And it doesn't need to go up into this gap here or even go to this buy sell liquidity pool to have profitability. So that right there in itself is a complete model. Knowing that we could potentially be turning in here and still hold a bearish stance longer term, but on a short term, you can take scalps or intraday trades based on the market structure that's here and work with this context. So that's what I mean by studying and looking for certain things. And when you have your charts annotated and you refer to them on a day-by-day basis and on the weekends, you want to look at the previous week and the week before and how you had your annotations, what the charts presented as a future response to that old area of order flow that you outlined. And just like this gap here, the market gravitated to that. Look at the bodies. You see that? It's respecting this area right there. So the algorithm remembers that. Does it mean it's done? No. It just means that this sensitivity here is directly related to this low end of that gap. So this is the discount end of that gap. This is the premium end of that gap. And then consequent encroachment would be the midpoint. And it just about gets there. It doesn't quite get there. But everybody's data, if they looked at a live chart or a live platform, their brokers quoted high on this particular candle here would be different. And some of us would see the consequent encroachment level hit. Others would probably just be above it. Or like in this case here, we look like we just fell short of it. But nonetheless, that's not what's necessary. Knowing these turning points that set up these price runs here, that is the basis to finding setups. Now, obviously, I'm not stating that you should be doing that because it's non-farm payroll and you shouldn't be trying to trade those days, but you can still use those days to study how liquidity is utilized for intraday price delivery. All right, moving down into the 15-minute time frame, you can see everything that's been transposed from the higher time frames to the hourly, and then now those levels are brought to the 15-minute time frame. You can see that order block. Now, notice that it's a little bit above halfway of all these down close candles, and that's why knowing the higher time frame levels and putting them on your higher time frame charts, and then using that when you're looking at your lower time frame, like 15-minute here or even a 5-minute chart, it gives you such a degree of perception that you can't really appreciate. And right away, some of you are smiling and nodding your head like, man, I have been wasting all this time, because if I just would have said the things you give in the commentary and applied them to my chart, and when I looked at my lower time frame charts, I would be seeing these things. Yes, yes, that's what I've been trying to tell you all this time. All these years I've been telling you to do it, but it strips you of that aha moment. And that's what I want everyone in here to have. So for the most part, it still can happen, but you have to be careful not to look at my chart before you have yours done. And then right away, it'll get you up to speed quicker. It's not meant to rush you through the mentorship. It's just meant to get you thinking more about involving yourself in your own study, being interactive with your charts, and then comparing and contrasting what I see as salient in price versus what you're looking at. Now, as you go through each month, even those that have become charter members, as you go through the content again, which is what you should be doing, you should be absolutely going through the content again. No one learns this going through the mentorship 1 or 2 times. But Michael, that's a lot of videos. Yes, it's almost 3 decades. What do you think's still coming? It's a whole lot more information. And it'll be easier for you to digest that if you go through the motions of going like this last group that's in 2021. They will have the highest amount of hand-holding that any group has had. Now, the first group is going to be like, oh, that's not fair. You should have did this for us. But you have the most insight. So you'll be able to glean more insight from going through it again. And with the new way of presenting these commentaries, you'll fill in your gaps that you still have a lot faster and a lot more efficiently than the new group, because they're going to have that whole discovery period too. They're going to have that don't know what I'm looking at, this is too much information. You went through it too. So, and if you're new and you're going through this, just know that you are going to get a tsunami of information, and it's not meant to disorient you. It's not a quick fix, hurry up and try to learn it all, because you're not going to. But you subscribe to this to be able to be a market wizard, if you will. You want to be able to look at the markets, any asset class, any time frame, decipher what it is, what it's going to do next, and have a 90% likelihood of being on side versus being offside. In other words, being on the right side of the marketplace. Now, notice I did not say 90% profitable. Okay, there's very specific terms that I avoid using here because of legality. Okay, if you do the work I'm telling you to do, I promise you, what you want to do, you will have the skill set to do, and you fill in the blanks as what that means for you, because I promise you, it will be available to you in your own skill and experience. But what you put into it determines your outcome and the results while you're here. Okay, so, and it's not a hurry up and quick fix, get me rich fast, show me how to learn how to trade in 6 weeks, or boot camp. Okay, that stuff doesn't work. Nobody goes through short-term teachings and all of a sudden now they're a market maven. It doesn't happen. Believe me, it does not happen, because I would have been corrected and shown by thousands of different yahoos out there that have pretended that that's true and sell courses and such. They can't beat me, and their students can't beat me. So again, it's not an ego thing. I'm just telling you, just look at it for what it is, because if they have the skills that they pretend to have, they would be able to do the things that you see me doing, and they don't. But you're going to be able to do these things. And once you have that skill set, no one can take it from you. But it's not going to come overnight. And every day you grow a little bit more. You whittle away at the rough edges, sand out some patches of rough ideas and understanding. And every day you get closer and closer, and that rough corner becomes smooth over time. And then over more time, you use a finer grade of sandpaper. And it doesn't feel as much change is occurring, but it is. And you're really smoothing out those minor little imperfections. And over time, you do more and more and more of that. And finally, you have a real smooth edge to everything. And you're not cutting yourself just being the analyst, hurting yourself. You're able to be fluid in any time frame, any asset class, any market. It's just an empowerment that I can't really articulate. But if you don't do what I'm showing you here, there's one absolute result. You will not learn what you came here for. Just know that, and you'll see if you go back and look at the other commentaries, I'm not doing what you're going to see me doing in this year anywhere else in any other mentorship. Like I haven't done this. So I'm making it available to you, so that way you can compare and contrast. So that way it'll get you closer to the market. You'll be more in tune with what's likely to happen next. But I'm not giving you trades. Okay, it's important to know that. But you'll see how the markets move and work off of these levels going forward, and more specifically, why they did what they did in the past. So I'm blending both of what you need to find in the marketplace that's salient, that leads to future price moves, that helps you with your prognostication. So anyway, 15-minute time frame, you can see we have the mitigation area in here. We hit it once in here, but left this imbalance and the order block inside of that fair value gap, which is defined by this candle's high and this candle's low. Remember, we're not defining it on the 15-minute time frame. These levels, go back and look at the previous chart time frames, and all we're doing is going down in the lower time frames once we have applied these levels on higher time frame charts. And then once we have them, we look inside of this candle's high and this candle's low, what resides in here. And we have a down close candle right there. So you have an order block within a fair value gap. Now, that order block might not be there. It could be a smaller fair value gap. Then that's what I would use. Okay. But because we have a down close candle in here, that's the order block within an imbalance, which is the fair value gap. And again, you'll learn what fair value gaps are by definition. If you're new, you're probably asking yourself, you keep talking about what a fair value gap is, but what is it specifically? You get lessons, okay? But you have to go step by step, okay? You will learn all these things. But I have to talk in the commentaries with the assumption that you're going back through the content. And this is why you have to do multiple passes through the mentorship, because repetition is key. And you'll know what I mean by watching a video that I did in 2016, 2017, 2018, 2019, 2020, and what I'm doing right now in 2021. Once you become a charter member, if you go back and look at those same videos, you're going to be astonished of the things that you're going to swear up and down that I made a different video. And I don't edit anything. Okay, let me toss this in real quick. For those that are month 12 content, there is and I may have the date right, so forgive me if this is incorrect, but off the top of my head, folks that have just rolled into month 12 level, there is a lesson, and I believe it's August 16th, part 2. It looks like it is messed up or whatever. When the video stops, that's really where I wanted it to stop, but it had an artifact in it, meaning like there's a call out or a little thing that I would use during the production of the video. So it made the timeline longer than it really was. And I don't edit anything. Once I put the video out and people can see it, I never go back in and change it. It's the litany test for me. I can't change anything. That's why you should download everything. But I say this to remind you that when you go back through and watch old videos, once you're charter level, you have gone through core content and you'll have access to trading models and trade plans. When you go back and look at old videos, it's going to feel like you are watching that video for the first time, and I'm teaching with a greater level of description and or detail. But it's the same video. It's just you have blinders on right now and you're not listening for the right things. You don't know what I'm referring to and its importance right now because it's your first pass through. And you haven't been exposed to the other lessons you'll have later on. So trust me, it's very dense. It's a lot of content here. And everything that's like what I'm saying right now, everybody complains about you talk too much. Get to the point. Once you're a charter member and you've been here for a couple of years, you're going to see this is all the point. The talking points is the point. It's not the thing in the chart, because there's a lot of things that need to be weighed in context. And the way you know context is understanding narrative. But you can't understand narrative until you understand the individual pieces that make up the PD array matrix. And you'll learn about that too. But I just can't give you everything, not because I don't want to, because I would love to have been able to do this. Just make it one time and there it is. And it's in one video. But I have so much understanding that I want to share with you that will help you, but you have to go through it with bite-sized pieces. And then once you do that, you will have a vision of why price does what it does, and you're not surprised by majority of what you see in price. And here's the important thing. This is why this lesson's important. You're going to learn why I choose not to touch a particular market. And it may be, for instance, say you're going to be a futures trader. Now, some of you are nodding your head thinking, yeah, I'm going to be a futures trader because I understand it's being taught here. Others are just in here because they want to learn Forex. Some of you may come in here and have just Forex on your mind, and you may end up becoming a bond trader or a stock option trader. Okay. You will determine who you are as a trader and what you're going to do. But these things that you learn are going to shape you, and you have to be aware of where it's leading you. And I don't push anyone in any one particular direction. Predominantly, I'm Forex because that's kind of like my forte. But obviously, you'll learn that all this stuff works in everything. And like in crypto, I was able to outline the big move this year going into 40,000. And just using the things that you're going to learn here. Now, I don't teach crypto. I teach price action. So the things that I use and lean on are going to be beneficial to all asset classes. But you may not feel that it's appropriate for you to trade stock options. But learning about them is good. You may not feel that it's appropriate to learn how to trade bonds. But even if you don't trade them, in certain market environments, it's important to understand them because it helps I guess, support a underlying